So what's next for the stock market and which sectors will be the winners and the losers? We turn now to Stephen Whiting. He's Global Chief Investment Strategist at Citi Private Bank. Stephen, thank you so much for joining us.
Thank you.
So who would have guessed back in January that this is where we would be in July? What is your outlook for the rest of the year?
Well, we had a good first half of the year. If you count in dividends, as we should, S&P 500 total return was about 7%. I would doubt that we're going to fully repeat that return. Third quarter periods have a history of being a bit more volatile, lower volume periods. And we do think that earnings are growing something less than what you would annualize as a 7% first half of the year. But we do expect that this unfinished economic recovery, which can continue for at least 2 more years of above-trend growth and rising profits, and valuations that are not terribly stretched, at least not compared to fixed income valuations, that will continue to see new highs over time.
As we know, the Federal Reserve is pulling back gradually, month by month, on the buying it's done of treasuries and mortgage-backed securities. Is the Fed going to help or hurt the economy and the stock market down the road, do you think?
Well, for the financial markets, I think it could be a source of volatility as we conclude QE in September or October. It'll put greater focus in on what a considerable period of time in which policy rates will be at zero really means. Fed Chair Yellen mentioned at one point 6 months or something like 6 months to quote her exactly. But we do think it's a bit longer period than that and more data dependent. But again, the focus will be very much on what is next out of the Fed when at the moment they're continuing to ease.
Mm-hmm. Let's look at some of the stock sectors and what you're expecting for the rest of the year. For this first part, utilities, energy, healthcare, they were the big gainers. What sectors do you think will do well and which ones won't do so well over the next 6 months?
Well, we saw a backing off of long-term interest rates in the first half of the year that we would not expect to be repeated in the second half. There have been good reasons why we've not seen unrelenting rises in interest rates, including the fact that U.S. yields are double German yields. So I think interest-sensitive sectors of the market will have a difficult time repeating their first half performance. The energy sector is interesting in the sense that global risks to oil supplies have picked up, with the events both in Iraq and surrounding Ukraine being issues that are unresolved. And that has shifted some of the benefits of an oil production boom in the United States back to producers. It is not something that we want to emphasize. We don't have a very bullish long-term view of oil, given how much production and investment has picked up. But it's a firmer sector than it was. In general, though, American industrial firms, are an area where we just think we will see a longer, stronger expansion for newly competitive American industrials.
What about overseas? Do you see better opportunities? Maybe Europe as they try and continue to deal with their own economic woes? China, which is starting to create this demand economy over there?
Yes, I think you have to keep in mind, in a place like China, there's a terrible lack of confidence compared to what there was some years ago. It's a market trading with roughly the same growth rate of earnings as the United States market, at half the valuation. In the case of Europe, people look at, particularly away from the north of Europe, and say, well, these are weak and fragile economies. But that's when we start an upturn. And that's exactly where we were in the U.S. market about 4 years ago. As banks deleveraged, we have seen, a sort of the U.S. being a leading indicator of what's going on in Europe. This has been the longest period of underperformance of European shares relative to the United States that we can record on record. So the European market has been catching up, and we think it can continue to, particularly in the periphery of Europe.
Okay. Thank you so much, Stephen. Appreciate your thoughts.
Thank you.
Stephen Whiting of Citi Private Bank.